Hello, this is Chuck with another video. The subject for today's video is the answer to a question. Will lowering the U.S. corporate income tax rates stem the outflow of jobs from America to low-wage cost countries? And better yet, will it help bring jobs back to America? Politicians have suggested two options. A, by lowering the corporate income tax rate, we will make America more business friendly. And therefore, American corporations will not relocate jobs from the U.S. to low-wage cost countries. And better yet, they will bring jobs back. Secondly, two politicians, President Trump and Bernie Sanders, have suggested that if we establish high import tariffs, we can stem the flow out and bring jobs back. In today's video, we're going to discuss only the corporate income tax rate. You've probably heard of or maybe been to an audience participation play. This was going to be an audience participation video. You are going to be the CEO of a U.S. manufacturing corporation that employs 20,000 workers. You're going to have to make a decision and then a recommendation to your company's board whether to or not to relocate 2,000 American jobs to China. You're going to need some background for this decision, and I'm going to give you that background right now. Your company pays the top tax rate in the U.S., 35% federal, plus you pay 5% state tax. Your tax rate in China will be 25%. If you continue to manufacture in the U.S., your tax rate will therefore be 35% federal plus 5% state, or 40%. If you manufacture in China, your tax rate will be 25%. When you bring the profits from China back to the United States, you will be subject to your 35% federal and 5% state, except you will get credit for the tax paid to China. So their rate is 25%, yours is 35%, you will pay 10% for federal, you will still pay 5% for state. So your effective tax rate, either way, is 40%. Your financial analysis department has told you that due to the lower wages, you can save 30 pennies on the dollar. So this is what we're going to do. Sales revenue for your company is measured in the tens of millions of dollars. It's a big company. But we're going to talk about savings and taxes in terms of what happens to a dollar of that sales revenue. And we're going to reduce that down to 100 pennies. So your company now makes a 10% profit, which is the average for U.S. corporations historically. That is, your company makes 10 pennies on the dollar, and you can save 30 pennies on the dollar. Once you relocate, then, your new profit will be 10 pennies plus the new 30 pennies of savings. The 30 pennies of savings comes from 32 pennies of labor cost savings, but you have to pay to get the product from China to the United States, and that costs you an extra 2 cents in transportation cost. So your net is 30 pennies. You now have the potential to make 40 pennies on the dollar. Boy, are you happy. Well, that's too good to be true. Here's what's going to happen. Your U.S. competitors are going to see what you were doing, and they're going to head for the exit. That is, they're going to relocate jobs to low-wage cost countries. Could be China, India, Mexico, but they're going to move. Market pressures will then force down pricing. At the lower pricing, let's pretend that you're going to now make 15 pennies on the dollar. Not 40 pennies, but 15. On that 15 pennies, you're going to pay 40% in taxes. On your 10 pennies that you are earning now, you are paying 40% in taxes. So out of every 10 pennies of profit, you pay 4 pennies in tax, and you put 6 pennies in your pocket. After relocating to China, on your 15 pennies of profit, you will pay 6 pennies in tax and put 9 pennies in your pocket. So you're going to put in 9 pennies versus 6 pennies into your pocket. That's a 3 penny difference. Now that doesn't sound like a lot of money, 3 pennies, but remember we're talking about millions of dollars, so that's a lot of money. Here is a decision point for you as CEO. Will you or will you not relocate the 2,000 jobs to China? You have 5 seconds to think it over. Good, you made the right decision. Yes, you will relocate to China. Let's now pretend that market forces, remember there's international players as well, and they're also moving to low-wage cost countries. Let's pretend that market pressure pushes prices down even further. In 3, 4, 5 years from now, your company will again be making 10 pennies on the dollar. Let's pretend also that you know this today when you have to make your decision. So, why relocate if you know 5 years from today you're still going to be making 10 pennies on the dollar? Okay, does this change your decision? You have 5 seconds to decide. Okay, you're right, it does not change your decision, because here's what's going to happen. If you had kept manufacturing in the United States, your prices would have been higher, you would not have been competitive, your business would have gone out of business. Additionally, because you did relocate the jobs, your prices are lower, and you are much more competitive internationally. Eventually, you may end up with only 5,000 employees in the U.S., but you may end up with 30 or 40,000 employees internationally. You'll be a much bigger company. Your revenues, instead of being, let's say, $2 billion, will be $4 billion. So you'll get 10 pennies on the dollar, or 10% of 4 billion versus 2 billion. That's a much bigger number than the number you have today, isn't it? So, even though you knew market pressures would force your pricing down, you made the right decision when you decided to move those jobs from the U.S. to China. What if the U.S. corporate income tax were reduced to 0? You would have a 25% tax due in China and a 5% state tax due here in the U.S. Your total tax rate, if you relocated, would be 30%. Let's assume, too, that market pressures had driven, after relocation, your profits down to 10 pennies on the dollar, the same as you have now in the U.S. So, after relocation, your taxes would be 3 pennies on 10 pennies, and you would put 7 pennies in your pocket. This is as opposed to the 10 pennies you now make here, and you would only have a half a penny to pay to the state, so you would put 9.5 pennies in your pocket. a 2.5 penny improvement. But this is theoretical, mathematically theoretical. If the tax rate was reduced to 0, how would this change your decision? You have 5 seconds. You're right, it would not change your decision. Here's why. If you had not relocated, you would not be price competitive, and your company would be out of business. So you would not have 2.5 pennies more to put in your pocket. You wouldn't have any pennies to put in your pocket. Additionally, you would not have had the opportunity to expand internationally. You're really looking not at 7 pennies, but if you doubled in revenue, you're looking at 14 pennies versus 9.5 pennies. So a reduction of federal income taxes to 0 does not affect your decision. You've been a CEO of a big company now for, let's say, 7-8 minutes. So I'm going to throw a simple question at you. And the answer to this question is also very simple. If 50 years ago, the U.S. federal corporate income tax rate had been reduced to 0, and all the corporate income tax rates at the state level have been reduced to 0, how many U.S. jobs would have been saved? I'll give you 5 seconds again. You're correct. Once more, you have made the right decision. There would probably, or possibly, and probably have been no jobs saved. 0. If taxes had been reduced to 0, the number of jobs saved would still have been 0. The difference in labor costs is so great that the tax issue is insignificant. All right, that's enough on taxes. In another video, I will address the issue of tariffs. I think there's some merit here, if done right. If you appreciate the information provided in this video, please tell your friends about it and subscribe to my channel. That's it for today. Have a good day. This has been Chuck.